just imagine yourself driving the cars that you love, building wealth while doing it, and building a legacy for your family, all at the same time without working harder, longer, or taking on any additional risk. It's not like when you're using a traditional bank, they're in control. In this, when you're your own banker, you are in control.
Capitalize your bank and then go finance your own cars. Quit giving that money away to banks and the finance companies.
Welcome back, everybody, to another week, another wealth webinar. Thanks for joining us today. I am pumped to do today's training because, here's the thing, and I don't know how many of you joined us for WTF this morning. I was on a tear. I definitely hit my F-bomb quota. No ifs, ands, or buts about it. Like, the quota was reached for the entire month of January. But nonetheless, one of the things I mentioned on the end is how excited I am about this training because this training applies to every one of you. Well, I guess, is there anyone on here right now that does not have a car, plan to buy a car, or plan to drive a car throughout their life? Anyone? Does anyone not plan to ever drive a car or own a car in their life? I mean, listen, like certain parts of the country, you could just ride a bike. You certainly don't want to be riding a bike here in Buffalo right now. So is there anyone that would want to just ride a bike all year long versus a car? The good news is what we're going to be talking about today is something that applies to all of you and something all of you are going to like. And essentially, let me start with a story. I know tons of people like this, but I'll never forget back when I was young, I was a teenager, I lived in a house with a bunch of other guys. It was kind of like it wasn't a party house, but it was like a skate house. In part of the upstairs, it was a house that was converted from a barn. So we had this bunch of extra space upstairs. We built a mini ramp, and we would have these parties where we would just skate all night long and big bonfires and everything. But one of the things that happened at that party is a buddy of ours came over with a brand new car, a super fancy Volkswagen sports car. It was like a really fast car. It was like supercharged. I don't remember what it was. It wasn't a Scirocco or a Corrado. It was like some other Volkswagen that they made. But he showed up with his car, and we're all standing out in that parking lot, or driveway really, but it was more of a parking lot, just walking around this thing going, how? Because he was like 18 years old. And this car, I don't remember what it cost, but way back then, we're talking about probably early 2000s. This was probably like a $38,000 to $40,000 car. And when he told us how much his payment was, we're just like, whoa. He kind of had a good construction job, but his payments were like $700 and change. But his loan was for 7 years. And I remember thinking to myself and going to one of my roommates being like, this dude's an idiot. He bought this car. His payments were over $700. He's 18 years old, and all of us were just in awe. We just couldn't even fathom how or why anyone would do this. Long story short, roll the clock forward. He did get into financial trouble, could not make the payments. They were after the car to repo the car. So I probably shouldn't say this, but it's long enough ago, and I'm not giving any names. He took the car out, and they literally destroyed it. They ran it into a tree. They flipped it over. The car was totaled, and he got the insurance payout. That's how he got out of that car. Now, that's not a situation I'd ever want any of you to be in. But can you just imagine if back then I just told him, I said, hey, what if you could get all the money back for this car and you don't have to drive it into a tree and collect the insurance proceeds? We want to learn about that? Well, that's the unique thing for all of you. That's what we're going to go over today. Now, if you've watched our 90-minute video, you've seen the car example where we show you how to buy 2 cars and how to get all the money back for the cars. But that example is old and it doesn't reflect how the policies are now. And every time I do a presentation, I just did one last Saturday and I was thinking about this. I'm like, this is an old example. This policy doesn't represent what policies look like today. It doesn't really show it. And also, we're only showing 2 cars. What would it be like if you buy 3 cars? So that's what we're going to go over today. We're literally going to show you how buying 3 cars looks when you do it from your own banking system. One more quick story. I remember just right before I entered Wall Street, right when the dot-com crash had happened, I had made a huge mistake. And I'm sure all of you have done this, maybe more so when you were younger, but you have that dream car. For me, this dream car was a 2000 Audi S4 Amolia yellow. It was a yellow S4, had a 2.7 liter bi-turbo. It was a used car. It had like over 100,000 miles. And I'm like, that car is awesome. Somebody had sent it to me because they knew I liked Audis. I couldn't afford it. It was just so you all know, it was a whopping $25,000. But that payment was over $500 a month. And I remember I financed it for 6 years. And here's what happened. I got into that car. That was right when I was really struggling. The dot-com crash had really crushed my retail stores. I was just starting. I remember I drove it to my first interview to be a financial advisor, and I was just starting as a financial advisor. So like I was just a broke ass kid entering Wall Street. But I had a fancy yellow S4. And long story short is I got so upside down in this car. It had a head gasket leak. It had all sorts of maintenance issues. I couldn't afford to do any of the repairs. So I remember with my tail between my leg, I rolled the car into the Subaru dealership where my buddy Martin worked. And I tried to get him to give me the highest trade-in he could, which I think the most he could give me was like $16,000. So remember, I paid $25,000 for the car. It's now worth $16,000, and I didn't have it for more than a year. And I traded it in. I rolled the balance that was due onto the WRX loan, which I did a lease for that car. I don't remember how long of a lease. Anyway, long story short, this is back before I knew how to buy cars. This is back before I knew how to get all the money back. But how many of you have ever bought a car, when you went to sell it or trade it in, you had negative equity in that car? Anyone? Anyone ever done that? Where literally you have to roll negative equity onto the next car? No. See, that's good. We got one person that has, 2 people. Johnny did. Got Angela has. Gabrielle has. Let's see. So, but just for anyone that has done that, you feel so defeated, don't you? You just feel like you got ripped off. You feel like you totally messed up. You feel like you're never going to get out of debt. And that's how I felt. So today, what we're going to do is we're going to show you how literally buying cars can make you money. I know that sounds really weird. And we're not going to sell the cars. We're not going to buy cars and sell them to make money. We're just going to buy cars. We're going to drive the piss out of them, and then we're going to buy another car, and then we're going to drive the piss out of it. We're never going to sell them. They're just going to accumulate in the driveway. Matter of fact, if you want, you can do some charitable giving, like give the car away to a family in need, and it won't matter. That is how you're going to learn how to buy cars today. This is wild. But first, I got to go through this thing, because how many of you are here for the very first time? Put I in the chat. Very first time, I in the chat. We got over 100 people on here now, and there's always a bunch of new people. So let's just see who we got. Wow, we got a lot. Look at the new people. We got David. We got a lot of new people. And I'm probably butchering some folks' names. We got Wendy here back for the second time. We got Randy. Awesome. Welcome to the show, folks. This show has been going on for years and years and years. We do it every single week. We don't sell anything here. Well, actually, I'm going to try to sell you something right now, just because I was about to say we never try to sell you anything. So I'm going to sell you something. Fair enough. This hat. Okay, we got these hats for sale. We're going to put the link up. If any of you want to grab yourself a new BYOB hat, there it is. We're going to have the link up there. So, new year. I gotta try to pay the bills by selling a hat. Actually, we don't really make hardly any money on the hats, but they're cool and we got to move them. So if anyone wants a hat, there's the link. So anyway, enough with that. We do this to teach you things so that you can improve your financial life. And one of the things that, building financial wealth, one of the cool things about it is what we teach and what you're about to learn. This isn't something we invented. This isn't something we created. This is something that's been around for hundreds of years, used by the wealthiest families throughout history. And here's the best part. It involves changing one thing, and that is where your money goes first, and adding one step, and that is how you use your money. Outside of that, everything you're about to embark on with buying cars is the exact thing you are doing now. And we're going to prove that. It's absolutely no different than how you're buying cars. And there are only 4 ways to buy cars. Hopefully all of you are only using 3 of them. Some of you are paying cash. We'll show you the statistics in a little bit on how many folks pay cash for a car. Okay. You're either financing the car, which is the most common, which is where you go to a finance company or a bank, and then you exchange monthly payments like we just talked about earlier of principal and interest for the car, and eventually you own the car. But anywhere during that period of time, you are negative equity in that car. And when you pay the car off, it's worth probably half what you paid for it. The third way, you could lease the car, okay, which is kind of silly. I know a lot of people and their CPA say, oh, go lease the car. You can write the whole thing off. You can write a car off that you finance. You could write any car off. There's different ways to do it. But leasing, you're making a payment to a finance company of principal and interest. And then after 3 years or whatever your lease term is, you literally just got to give the car back. So you just rented a car. And you did it because, oh, I needed the tax write-off. If you needed a tax write-off, you should have went out, found yourself a vehicle over 6,000 pounds, bought that vehicle, gotten the 179 deduction on it, and hopefully they revert that 179 to 100%. But nonetheless, I'm not here to teach you about that. The fourth way, you could steal a car, but do not steal a car, because this might be your last webinar, because you'll probably be in jail. And I don't think they let you watch Wealth Webinar in jail. So that's what we're going to do. Now, here's a question I got to ask everybody. What do all of you think is the number of cars the average person buys in their lifetime? Go, put it in the chat. How many cars do you think somebody buys in their lifetime? Put it in the chat. Holy cow. Look at that. All right, some good guessing coming in. Really, 3 to 5, Brittany said. That'd be cool if somebody said one car, because like, hey, listen, you could buy like, there's that story of that guy that had that, what, Rolls Royce, and he owned it like 70 years, and the car was like mint. 10, 4 to 7, 20 cars. I like Beresford. He's buying cars like I am. Make money off the sales tax also. 50 cars, David said. David's a collector. We got Jamie said 7, 10, 8. So the amount is 8 to 10 cars. So let me give you some useless facts that we pulled up here. The length of vehicle ownership, the average American owns a car for 6 to 8 years before replacing it. The age of driving starts at 16 and continues to mid-70s, which means we have a driving span of 60 years. What a long freaking time we drive cars. And I don't know why we don't drive after the mid-70s, man. I'm going to be driving faster in my mid-70s, because in the mid-70s, you're just like, shit, man, if I put this car off the road, does it really matter? I've got a lot of time in, like, hey, let's just go pound the pedal down to the metal. Anyway, but I guess not everybody thinks the way I do. And the financial capacity, economic circumstances influence how often people buy cars. So anyway, completely useless information I just went over. But what we're going to do, we're going to dive in. Craig's got a spreadsheet and a bunch of stuff. Surprise, surprise. There's a spreadsheet here, but it's really well put together. John, great guess. So 8 to 10 was the answer there. And folks, as we go through this, if you have questions, put your questions over there in the questions and answers. Now, Craig, in light of us doing this webinar today, teaching people how to get all the money back for all the cars, can I just take a second and just transition about something I'm really excited about? And this isn't going to land for all of you, but when I was a boy, I was infatuated with Porsches. I had Porsche Matchbox cars. I had a poster on my wall, and I'll never forget it. It was a black 930 turbo wide body, and it had black fuzzy dice hanging from it. This poster stayed on my wall for my entire childhood, which means every night when I went to bed, I stared at this car, and every morning when I woke up, I looked at this car. It was seared into my mind. Now, throughout those early years that I was talking about, I never dreamt of even being able to ever have a Porsche. Just could never afford it. They're too expensive. Like, it's so silly for me to even think about it. When I was in high school, I had a friend, Alexis. Her dad was Moscato Law. He owned a law firm. Great guy. And in his garage, when I was over there one day, we were getting ready to go to a party or something, I saw a silver Porsche 911 in the garage. So all of a sudden, my mind triggered, and that original dream of that car that was on my wall as a child, there it was. Yes, it was silver, but there it was. So I said to Alexis, Alexis, do you think someday your dad would give me a ride in the car? She runs inside. She comes back out and she says, Dad gave me the keys. Let's go for a ride. End of story. It was concrete right there, because that now went from a poster on the wall. First time, I'd ever sat in a Porsche or any even car remotely nice like that. When she started it up, I was sold. But I wouldn't have ever been able to buy that car for many, many years. If you watch the commercials, you will see, like, it's a journey. So I have literally worked with my team to create something that I think is really special. And just today alone, we launched, and I'm showing you it right here. It's called BYO Porsche. Not BYOB, but you'll see where the similarity comes in. BYO Porsche. Bring your own Porsche. And this whole channel is all about the journey, embracing the journey. I kind of just told you several journeys I was on with cars, the S4 bad journey, and then the Porsche journey. Okay. That's embracing the journey, but then chasing the dream. So much of what we do in life is about just chasing dreams. It's about really taking the time, the energy, the effort to put into actually acquiring and fulfilling on a dream. A Porsche, it's just a car, it's just a little thing, but it's more than that because it's the journey it took to have one of those cars sitting right here. And now not one, but now five. But it's not a sickness or a disease. Some of you are like, you have 5 Porsches. I promise you it's not a sickness. It's an investment because if I know how to get all the money back for every Porsche I buy, and I know how to make money buying these Porsches, why would I not? And given the times, I just felt that like this is the lowest risk. So with that, and in light of that, we have launched this channel. So I am asking all 115 of you if you could do me a solid. Since we do this show for free, we ask for nothing outside of, I told you can buy a hat. I would love for you to subscribe to this YouTube channel. It's called Bring Your Own Porsche. We've got the brand new video. It just went up, and it's
Welcome to BYOB Porsche. My name's Chris Naugle, and I'm on.
All about the sound. There are so many points in this video where all it is just the sound
He
of
gave
the car,
her
telling
her dream.
music, cinematic. Anyway, don't want to bore you, but it's a car. You can take the. It's pretty funny. We do some fun things. Anyway, enough of that. All I wanted to do is ask if any of you or all of you would just go on and subscribe to that channel, because today is the first day. Every month we will launch a new video. Every month it will be a different story. It will be cinematic. It will involve engine notes. It will involve sound and music, and it will really captivate you. So check it out. With that being said, Craig, I'm going to give you the ability to share because I've said what I want to say. Let's dive into how all these people can get the money back for every car they buy, drive, and own. Not just a little bit of money, quite a bit.
All right. So I know that Chris has talked a lot about some of the cool cars he had. And before we get started talking about how we're going to buy 3 cars throughout our lifetime within a 15-year period, I wanted to start off with just kind of asking the audience, what was your first car? What did you guys have? And I'm going to share what I have as well. And here it is. These are some relics from the past, but the first car that I owned was a 1961 Corvair. And we always used to say there's 4 on the floor and 6 in the trunk because it was a 4-speed manual. And then, of course, the engine's in the back, air-cooled 6-cylinder. I had that car for a little while, restored it, played with it for a while, but then it moved on to this Camaro. Now, this 1976 Camaro and myself, I bought that when I was in high school. My dad and I restored it. We did the paint, the interior, the engine, and it's still in my garage. So I still own that car. But anyway, just want to kind of, see what others had. We had some Camrys, Hondas, Regals, 65 Mustang, Capri, 59 Chevy, a Gremlin. Yes.
Cars, a Gremlin. My aunt had a Gremlin. That's a pretty cool little car.
Yeah. It was kind of watching the Mecum auto auction last night. I am blown away by the price of some of these cars. We're talking
look at that,
150, 200,000.
Ford Torino, man, that's a legend right there.
Yeah, the 69 Firebird.
So cool to go back in time and look at these cars. A Corvair
Chevelle.
Monza Spider. Wow. Was that your first car, David? Fancy.
Well, think about all those cars, and hopefully you had some good memories over that. And just, I'll tell you what, there's so many cool things when you start thinking about the cars we used to drive. But with all that said, let's start talking about how people buy cars. And Chris already talked a little bit about this. I found this on the Zebra. So if you go out to the Zebra, they actually have a cool little article out there on car buying by generation. But ultimately what they're showing is about 5% of the people get cars through gifts. And I was thinking to myself, well, wouldn't that be cool to get a gift, a car as a gift? And I did. When I got out of high school, my aunt and uncle gave me their 1972 Kingswood Estate station wagon. This thing was a bomb, but that's what I drove through college. So 5% of us are getting gifts, 7% do the lease option, 38% are just paying cash for those cars, and then 50% are doing financing.
Let's ask everybody, hey, so you guys put up some really nice cars. Like
Mhm.
if these are the different ways that, people are buying cars, how did you get your first car? What would be interesting, Craig, is to see how many people from the older generations, like,
Yeah.
baby boomers, silent generation, my generation, Gen X, how many of them were gifted a car? I bet you there's very few. I certainly was not. But yeah, look at a lot of people were gifted cars.
Yeah.
Yeah,
Yeah.
cash. I paid cash for my first car. It was a whopping $500. Yeah.
Yep. Shane had the paper route. I used to, I lived in Nebraska, so we did a lot of corn work but yeah, that was,
Love it.
yeah, and cars were cheaper. That's definitely true, Scott.
You know what's interesting? Like, as we kind of look at that and we look at these stats, I was surprised, Craig, when you showed me this, and it
Yeah.
showed 38% of car acquisitions were cash. That really surprised me. That means there's a lot of people saving up money to then pay cash for the car. And can anyone tell me what's the worst part about paying cash for a car? Can anyone tell me what that is? Like, if you pay cash for a car, there's one major negative, and it's not that you're buying a car that's guaranteed to depreciate. It's right. The cash is gone forever. The cash can never earn for you again in your life. So you lose the earning potential on all the money you pay for a car, which isn't a huge deal for our first cars that, $1,850, $100, or I paid 500. Like, that's irrelevant. But, if you today paid 20, 25, 30 grand for a car cash, that's 30 grand not able to work. That if you ran that into a compound calculator at just 4%, that amounts to a shit ton of money over a long period of time, wouldn't it, Craig?
It would. And what kind of blew me away about this graph is, we see the boomers, they're doing mainly financing, but look at the Gen Z. They're laying down cash for cars. So
Crazy. And I would have never thought that. How about you, Stephen? Would you have thought Gen Z was mostly paying cash for cars?
No, I do not believe that.
It's great. Well, it's right there.
I don't believe whatever zebra is.
he doesn't believe the zebra.
Just
If you were on WTF this morning, folks, you would have saw me talk about the banks reporting their profits. And all the big banks that have access to the Fed's balance sheet, they're all reporting really good profits because of increase in interest income. Because there's so many people financing cars and using debt, they're paying tons of interest, and interest rates are relatively high now, so they're making even more. So they're bragging about how much their profits are on the increase in interest, and that was JP Morgan Chase this morning. That should piss all of you off. But when you're done with today, you're going to learn how to be the bank, and you're just going to say, you know what? I'm going to report the best profits I ever have because of interest income.
Well, let's move on. I do think it's interesting. They're showing Gen Z as the cash, but like Steven says, he doesn't trust the zebra. After all, it's just a horse with prison stripes. So let's move on. All right. So there's a few ways we can buy cars. We see that Gen Z is doing what we call the save and then spend method. So if you think about time and folks that save up their money, so whether the Gen Zs are saving their money or using their parents' money, somebody's saving up money and then they're spending it to go buy a car. Then they save money and they spend it to buy a car. So we always end up at zero, right? So we're always ending up at the same place. We save and we spend, we save and we spend. That was the second way people buy cars, but the most popular is this borrow and then spend. So we'll take a loan, we'll work our way for say 5, 6, 7 years of getting back to zero, and then we'll take another loan. And I do want to kind of piggyback off what you were saying, Chris, where people are taking loans on cars and then they're going negative on those cars. And then they buy another car. And my middle daughter's in the auto industry, and she was sharing with me at our family dinner on Sunday. Youngest had a birthday. And she said she's seeing more and more people that are in that negative equity where they're buying a new car, rolling that equity into the new car. And guess what rate she said they're typically seeing for their new car loan?
7%?
28%.
Wait, whoa.
Yes,
Hang on a
28.
second. For a car loan?
Yep, for a car loan.
How? Why? That's like credit card rates.
These are people that are struggling, I guess, financially. They have negative equity and they're rolling it into another car. And she said she just cannot believe how many people she's seeing coming around with 28% loans. But pretty scary.
Dude, that's like usury, man. That's borderline usury for a freaking car. those people never get ahead. Anyway, sad for them, sad for them.
So now what we're going to talk about today is this, you could almost say save, spend, borrow, because what we're doing is over time, if you look at this green arrow, the savings, the wealth is going to continue to go up while we leverage. We're going to borrow from that thing and then we're going to pay it back, borrow from that thing and pay it back. But you'll see that that does not stop this green arrow from continuing on up the, up the stack, and our savings continues and continues. So we'll talk more about how that works and what the tool is, but that's the focus of what we're covering today. So now let's go buy some vehicles. And what we're going to do, just to kind of set the table, is I went out to bankrate.com. You can go out there, you probably find some other rates, but I'm just kind of looking for a ballpark. Looks like about 6.39 is a reasonable car loan rate right now. Minimum credit score 600. Yours could be higher, could be lower, but that's what I built this case study on. So the first car we're going to buy is a 2025 Toyota Camry, and we're going to buy that for $30,000. Now we're probably not getting the WeatherTech, floor mats, all these fancy things. This car does come with turn signals though, and so that's one of the options we're going to be using.
And alloy wheels.
What's that?
And alloy wheels.
And alloy wheels, yep. So for 5 years, we're going to finance this car at $585 a month, which means our total payments will be $35,129 or $126, and the interest that we're paying is $5,126. Now, in 5 years, we're going to have spent $35,126, and we'll have a paid-for car. And then 5 years later, although this says a 2025 Tesla model, that's what I'm using in today's model, but this could be a 2030 by then. But we're going to spend $50,000 on this Tesla, and our payments are going to be $976. So we're spending pretty close to $60,000 for that Tesla, and about $8,544 is interest.
That's
now,
wild to think. Like, Craig, just pause for a sec. A $50,000 car, that's like kind of the norm, right? Like, Toyota's Camrys are like the #1 selling car, but most people are buying the upgraded ones for like 38, 40 grand. The Tesla Model 3, nice car, but it's kind of a lower price point car for Tesla at 50 grand. This is the first time I'd seen that $50,000 car financed over 60 months is almost $1,000 a month. I did not know that. Ouch.
Yeah, isn't that wild to think about that? $1,000 a month for your Tesla.
Gone.
Bye. Now here's what's cool is this next thing. I can get into this 2025 Ford Raptor truck. And we're talking, I mean, if you go out truck shopping, $85,000 doesn't sound like a lot of money when you start looking at some of these trucks that are 90 over 100,000, but that $85,000 Ford Raptor is going to, cost us about $1,659. And just to think about over 5 years, that's 100 grand out the door.
Yeah. Wow. I mean, a 2,500 diesel is pushing over 6 digits.
Yeah, it's nuts. Absolutely nuts. But these are the 3 cars we're going to buy. We're going to buy them in 5-year increments. And so let's take a look at that. So let's go buy some vehicles. Before I go jump into buying vehicles, I do want to just mention there could be some folks on here today that say, well, guess what? This doesn't apply to me because I've already got a car loan. I'm stuck with that. I mean, I can't do what you're talking about. But I do want to share that we can still implement this process if you have credit card debts, if you have car loans, student loans, if you're one of those many people that, didn't get their student loans forgiven and you have to pay for it. We can use this same process to show you how you can pay those debts down more effectively, or how you can pay that existing car loan off more effectively and use this process we're talking about. We could have some people here today as well that like, hey, I don't have any debts, I don't have any car loans, I don't plan on buying cars for a long time, and you want to learn how to use this process to invest. We have a methodology for that as well. And the last thing we're talking about today is how do we make major purchases? I want you to stay focused on the cars, but after the meeting and your mind races, you can think about, well, what if I'm not purchasing cars? What if I'm paying for college? What if I'm, doing home renovations? These are just major purchases. We're showing you how to buy cars, but this applies to pretty much everything else in your life that's a major purchase. All right. So I just want to share that with you. Chris, before we jump into the car buying, do you want to just do a quick refresher on infinite banking and how that works for the
Yeah, because I think a
audience?
lot of folks are asking. I know somebody earlier had asked, what is this all about? So if you want to stop sharing your screen, I'll just kind of show you. So basically, now that we know we're talking about buying cars, you know what it would cost to finance them, you know what it would cost to pay cash for them. How do most of you do that? Well, you do it from a bank account, cash. You put money into a bank. Some of you right now are in high yield savings accounts. But the problem is if you take the money out to buy a car, because that's what we're talking about. What was that payment on that? It was like 500, the Toyota. How much was that?
580, 585, I think.
585 for a $30,000 car. Okay. So if you take cash out, which we know a large percentage of people are paying cash, and we do that, that cash that was in that high yield savings earning maybe 4% is no longer earning anything. So essentially, what we're going to do is we're going to apply a process to buy the cars. Okay, and the process is a process that allows you to take back the banking functions in your life. Now, this process is goes by several names, but most commonly, the late R. Nelson Nash in Becoming Your Own Banker, his book, he talks about this, and that is the infinite banking concepts. Some of you may have heard kind of people talking about it in the groups that they would call it privatized banking. We call it be your own banker, but it's the same thing as the infinite banking concept. So here's what you do. Now, this first part, just stay with me. The first part isn't going to make sense to some of you. Well, a lot of you are already doing it, but instead of putting money in a bank account, what we would do is we would change where you save the money, okay? And we would put it into a specially designed an engineered whole life insurance policy from a mutually owned company that pays dividends. Now, let me preface, because some of you are brand new here, we are not talking about a regular whole life insurance policy that your broke-ass brother-in-law tried selling you. It would never work like what you're going to see. We are talking about a highly specialized and highly designed policy that we create for this. So why would we use a whole life? I think that's probably the main question people ask. And, listen, in the chat, if you're, what is the first thing most people think about when you hear the word whole life? Hang on, I'll just tell you. High commissions. You've heard the gurus like Dave Ramsey and Susie Orman saying that's the worst place you could put your money. You should buy term, invest the difference, but that's okay. We did a white paper debunking that whole thing. And you've heard all sorts of other things, but you've heard all those things about a regular whole life insurance policy. Dave Ramsey's never been like, well, but then you could design and engineer this whole life and it does this, which you're going to see the numbers in just a second. But here's the reasons why we use a whole life, not a bank account, not an IUL, nothing else. A whole life is, number one, they pay a guaranteed interest rate. So some of you are asking, well, how much is that interest rate? Well, depending on the company, it could go anywhere between 2 and 3.25%. That's the guaranteed interest rate. But wait, there's more. These are mutually owned insurance companies. So therefore, the policyholders are kind of like owners of the company. They get to share in the profits of the company in the form of a return of unused premiums that the insurance company doesn't use. So every year, for hundreds of years, well, I shouldn't say hundreds, but the youngest insurance company we work with has been paying dividends consecutively every year, never missed one, for 143 years. The oldest is around 160 or 170 years, never missing one. We don't have one mutually owned insurance company that has ever missed a dividend. So the dividends are an important factor that the insurance company pays. So if we just kind of look at the guaranteed interest plus the dividends, what you're looking at from a dollars and cents standpoint is anywhere between 5.75 and 6.4%. So right off the bat, do any of you have a bank account that in a contract will guarantee you between 2 or 3.25% for the rest of your life? The answer is no, and don't even try to tell me yes. There's not a single bank in the world that would guarantee you an interest rate locked in for the rest of your life. They're all going to be fluctuating based on Fed rates. Insurance companies do contractually guarantee it. Plus, with the dividends, which are not guaranteed, but they paid them every year, we're getting up around this 5.75 to 6.4. So let's just for today kind of go in the middle, and we'll just say 6% for simple math. Does anyone have a bank account that has paid them 6% for any longer than a year, 2 years, 3 years, 5 years? Not one of you. So we're already better off. But hold on, your bank account where you're saving money, every year the bank does a really cruel thing and mails you somewhere around January or February this thing called a 1099. For the minuscule interest that the bank paid you, then they have the audacity to send you a 1099 saying, hey, now you got to pay tax on that little interest that we paid you. You see, the insurance companies, if the policy is designed right, that 6% is tax-free if it's designed right, specially designed and engineered. Not only that, it's protected. So, sometimes what happens is if somebody is saving in a bank account and all of a sudden they get sued, their bank account gets locked up. So their money's not protected, but in the policy, it's protected against judgments and liens in most states. And lastly, it provides an instant legacy in the form of a death benefit. So already just looking at the stats of the whole life, is that better than what you're getting in your bank account or your money market account? 100%. But here's where people don't like whole life. All that sounds good, but then someone on here is saying, yeah, but you can't use your money for the first 2 or 3 years. Wrong. In the specially designed and engineered whole life policies, we're going to have access to that money immediately in the first 30 days. When your check clears and the insurance company posts your check, your money's available. So the infinite banking concept isn't the whole life. I'm just making the case that the whole life is just a better option than your bank account. So the infinite banking concept it works like this. We're going to buy a car. Okay, we're going to buy 3 cars today. So you have a decision. Are you going to pay cash for the car? Are you going to finance the car? Are you going to lease the car? So let's assume that you would finance a car because that was the majority of the people. Great. If you were going to finance a car, you're going to agree to pay a monthly payment and an interest rate. Craig, what was the interest rate?
6.39.
6.39% as of today was the average, okay? So if you're going to finance a car, you're going to pay that. Now, let me ask all of you a question. Would you prefer to make a $585 a month payment, 6.39% interest for 5 years? Would you prefer to make that payment to yourself or to somebody else's bank? See, I'm leading you all. Of course you'd much rather write yourself a check for $585 versus paying Bank of America or JP Morgan Chase $585. So that's all this is. It's a process of you taking back the banking functions in your life. This is the banking functions we're talking about. Most folks are going out there and using a traditional bank to finance their cars. And then the rest of them are using cash, but both of them are a failed method because here you're giving all that money and interest away to somebody else. And in the cash, you're stopping the growth of the money. So here's how the infinite banking concept works. We're going to save up $30,000, just like you would in a bank account. And the whole time that money's saving up, you're going to be earning that guaranteed interest and dividends tax-free. Then when we save up enough money, and it could be immediately in the first 30 days, because I bet you a lot of folks on here have the money in a bank account that they've been saving up for their next car or for the next child's car. That money's in a bank. So you could take that money from the bank and just dump it into the policy. So you could say, hey, I got 30 grand in my savings. I'm just going to dump 30 grand into the policy. Perfect. Now, in the next 30 days, what we're going to do is we're going to take that $30,000 and we're going to basically have the insurance company ACH that money into our bank account. But we're going to recommend that you go to your bank and open up a second checking account. We call that a segregated account. So that bank account is now $30,000 in balance because we took a loan from the insurance company for $30,000. But I'm not going to skip over this because this is the part that people get hung up. I just met with this guy, spent 2 full sessions, me and Craig, with this gentleman, and we outlined the entire process of how this works. It was miraculous what it did. It paid off all their debt. It bought a lake house. It got them all the money back. It slices it, dices it, chops it, maneuvers it, weaves it. It was that. And then this guy sends me an email, no disrespect to him, sends me an email as, well, I don't want to take a loan of my own money. And I'm like, in 2 days, what were you doing when we were explaining how this works? Because here's what he thought. He's like, I put 30 grand into this thing, and then I take a loan, and I got to pay the insurance company interest. Let's just call it 5%. And that's a number. Different insurance companies have different rates. Some are less than 5, some are more. So now he's sitting there, and he's saying, I don't want to pay 5% to use my money. But if I said to all of you, and I want every one of you to pay attention here, and I want you to put this in the chat. If I said this to you, if an insurance company was willing to pay you 6%, hypothetically, if they were willing to give you 6%, But then for you to use your money anytime you wanted with no questions asked, you had to pay them 5. How many of you would take that deal? Sign me up. You're going to pay me 6 and I'm going to pay you 5. So I make a 1% spread. Hell, most people are not even making 1% on their checking account or savings account. So right there, that just makes logical sense. Not only that, the 6% that the insurance company is paying me is compounding. The 5% interest that the insurance company is charging me is simple. Now we get into like mathematics of what's the difference between compound interest and simple interest. It's a huge difference, but you're going to see the math today. So what we do, we take that 30 grand out and then we buy the car. We've bought the car. Now this is the easy part. You were already going to finance this car or you were going to pay cash for this car. Now, if you had a place where your money could earn 6%, would you want to take the money out of that account to buy a car? I know a ton of people that have money in a bank account or a money market account making 4 to 5%, and then they will go finance a car for 6.39. And I ask them, I say, well, why didn't you just take the money from the bank and pay cash for the car? And they say, well, we just wanted to make sure we had an emergency fund. We wanted to make sure our money stayed there because we're making a good interest rate on that money. And we could just finance the car and we can pay it off at any time. That's backwards thinking. But it's not. So what if you could use the 30,000, still earn the 6%? Yes, you got to give 5% of it back, buy the car, but then we make the same payment, the $585 a month that you were going to make on the car, but we make it back to yourself. So $585 a month, the amount you would have paid, whatever that finance company is, what we do is we literally just redirect it. We put it back into the policy. Now, why would we do that? Well, because you need to think like you are a bank because you're creating a banking system. You're becoming your own banker. So you have to mimic and do what a bank does. Remember I said all those banks reported these huge profits today? Yeah. You need to do the same thing. And in order to do that, you got to do what a bank does. And a bank doesn't just give you a loan and not ask you for a payment ever. So you're going to do the same thing that the bank would do for your banking system. But here's the best part. Every payment you make of $585, this will change your mind. The $585 a month that you pay back to the insurance company, that money goes into your account and can be used the next day. So literally every time you make a $585 payment back to your policy, you have $585 to use the next day. And some people would be like, well, why would I even bother if it's no different if I just left it in my bank account or put it in the policy? Here's why. The $585 a month you're paying is reducing the loan, but you don't lose liquidity of it. Okay. I know a lot of people that make extra payments on their line of credit so that they have extra money to use, in their line of credit. But here you're doing the same thing. You're making $585 back, but by doing that, you're reducing the interest you're paying the insurance company. Again, we'll show you the math on that, but that's why you pay the money back. So literally, let's simplify this. All I did is I drew a circle. The money started here in this specially designed whole life. We took it out. We used it to buy a car in today's example. Then we made the exact same car payment we would have made to whatever finance company or dealership you were going to buy the car. We pay that amount back, and that money shows up in our account the next day, but it reduces the loan, which reduces the interest we're paying on the loan, but you lost no liquidity. That is the infinite banking concept. Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris. Now, what Craig's going to do is walk you through the mathematics of how this works. And at the end of this, if anyone was like, I would never do that, I literally need you to go see a doctor. I'm going to beg you to go see a doctor or a psychologist and just have things checked out, because if after you're done with this, you don't think that this is a very, very compelling way to buy cars, then there's something else wrong. And we need to figure that out. So Craig, rock on.
All right. Thanks for going over that. So we're going to kind of keep with that same theme. And now what we're talking about is, in this use case, we need to come up with a specially designed whole life policy. I'm not going to go into all the ingredients, but when Chris talks about these are especially designed, there's a lot of buttons and dials we have to turn. But essentially what we're doing is we're creating a policy for a 30-year-old female who's dumping in $34,000, and then they're going to put in $6,000 a year. So this is where all their savings is going. For those of you that have been around the campfire and know what it means to put 60% into paid up additions, that just means a lion's share of that premium is going into the cash side of the policy and 40% on the base. Now, when we talk about policy design, Nelson Nash always, he tended to use a 60-40 policy design quite a bit. We sometimes increase that even higher to where could be 75% of your premiums going into paid up additions. But with all of this said, these are all the ingredients that went into the policy. If you want to take a screenshot, look at it later, but this is how the policy was built. And what the policy does is you'll see in year one, we've got 40,000 going in because we've got the 34,000 dump plus the 6,000 premium. And just like Chris said, there's guarantees, and then there's cash value with dividend. So this is kind of where we're seeing everything in the blue is kind of that non-guaranteed. It's with the dividend, but they've consistently paid those, for over 100 plus years. But imagine, if you will, you're putting 40,000 into your banking system. Within the first 30 days, you can take out close to, $35,000, $36,000 and go buy your car. So really what we're doing, I'm not going to focus on policy design a lot today, but I just want you to be aware this is how the policy is working. We're able to get about 93% availability of every dollar we put in that policy at the end of year one. At the end of year two, we're able to get about $1.10. So this is a really, really well-designed policy. Now, if you walk down the street to someone that just creates a whole life policy, you put 40,000 into that policy, you may not have any cash value year one. You might have a couple bucks in year two. That's why it's important to work with someone that knows how to develop these policies and understands this process. But with all of that said, let's jump into it. We're going to buy our first car. So remember, we're buying that 2025 Toyota Camry. And what we're going to do is we're going to dump in the 34,000 into the policy plus our 6,000 annual premium. And then within that first 30 days, we're taking out $30,000 and we're going to take that over to the dealership and buy our car. Just like we talked about, and Chris just went over on the board, we're taking that $585, the same amount that would have gone to the bank or it would have gone to the dealer. We're just running that back into our system as a loan repayment. So this is all you do for the next 5 years is you'll, every year you'll put your 6,000 in. Every month you're putting 585 back in the policy. Pretty simple. I mean, there's nothing magical here. That's what our motion is with the money. Now, for those of you on the call that love numbers, spreadsheets, these are some of the numbers behind the scenes. If you're not a numbers person, just maybe, gloss over this for a moment. But essentially what we're doing is we're taking $30,000 out as a loan. That loan in the first year is going to cost us $1,309 of interest going to the insurance company. But I want you to look down this column. Do you see what's happening as we pay that loan down? The first year it's $1,300, then it's $1,000, then it's $724, then it's $409, then it's $92. That's exactly what Chris was talking about when we're paying back that loan. It's on a decreasing balance, simple interest, which means we're paying less and less interest every year. However, our 30,000 or that 40,000 we put in the policy continues to compound and grow. So what's happening is we're now taking that $585 a month, which equates to about $7,000 a year, and we're putting it back into the policy as a loan repayment, which also increases our available cash value along with the premiums we're putting in. Now, for those of you looking at the math, you'll see, well, I put in $7,020 in loan repayments for 4 years, but then the 5th year, I'm only putting in $5,481. Well, that's because we paid the loan back to the life insurance company, and we have $1,538 that would have otherwise gone to the bank or to the car dealership for the loan repayment. But that's also our money. We can take that and put it in as premium. If there's room in the policy, you can stick it in your pocket. You can use it for premiums next year, but it's something that's ours. And yes, you would want that to go to PUA, Stephen, if you could. See, Stephen is asking PUA, right? Yeah, absolutely. This would go into our PUAs, which would not only make our policy more efficient, but it'd grow more and create more cash value. So the points here I want to just make sure everyone sees is we're taking a loan interest decreases over time. We make the same payments back. We're going to overpay that loan, and that extra money goes into the cash side of the policy. So by the end of 5 years, we have $66,121 of cash value and a paid off car. Now, for those that are a little more visual, what I want to do is just kind of talk about at the end of 5 years, we now have $66,121 of cash value. We have a death benefit of $826,000. So God forbid something happens to us while we have this car loan, your family will have more than enough money to pay off that car, take care of other things, and have extra money to use. So that death benefit comes along for the ride. Although we've got $66,000 of cash value, we've only put in $64,000 into the policy in terms of the premiums and the dump in by that time. Now our total loan payments that we've made back into our system is about $35,100, and remember, $1,538 of that was loan overpayment. So now the way I'm looking at this is let's figure out what the benefits are to us. Well, would you agree that this cash value that you have available to you is a benefit? Yes, I think that's a benefit. You now have a paid for Toyota Camry that you had a benefit of $30,000 because you would have spent that otherwise, but that's what the benefit was $30,000. And this $1,538 is a benefit to you because that's cash in your pocket or it went into premium. So if we take and add up all the benefits, $66,121 of cash value, plus the $30,000 car, plus the $1,538 that was the overpayment, we have a benefit of $97,659. Now, in order to get that benefit, we have some things that are coming out of our pocket. We had $64,000 come out of our pocket that was premiums and dump in. We had $35,000 come out of our pocket that were loan payments. So this $97,000 benefit cost us $99,000, $100. So here's the way I look at it. If you divide the benefits by the out of pocket, this means we've got 98 cents of every dollar back on that car that we purchased by doing it this way. So this car, the difference between these two is $1,441. So you could almost look at this as I bought a $30,000 car for $1,400. That's one way to look at it. Or you could look at it that I got 98 cents of every dollar back on this car that I purchased, and I have $826,000 of death benefit.
And the car is still in the driveway. Didn't have to trade it in, didn't have to do any negative equity, didn't have to sell the car. It's just sitting in the driveway and it still has value. Craig, before we move on, Zach had a good question. He said on month 60 from the first chart shows cash value at 70,000 or 74,470 are these different examples. So that's a really good question because, we're looking here 66,121 is the cash value, but when he looked at the chart you did, the illustration, it showed, and we'll just go back to that really quick right here in year 66,121. So yeah, he was looking at year 6. So you were just 1 year ahead.
Yeah, but that's a really good observation because what will happen, let's say that when we take, let's say I took a $10,000 loan here, although your full amount is compounding, and this is really, really important distinction, although your full amount is compounding, what this cash value is showing you is what is available, what's left, what's available. So if I took a $10,000 loan off of this, then my available would be $27,231, not 37. So that's just
37 is still earning interest and dividends.
correct. Yep.
Perfect.
But
Thanks for
yeah, that was a really good observation. I'm glad he brought that up. So that's our first car. So let's move on to 5 years later. It's time. We've got the Toyota Camry sitting in the driveway. We're still putting in our $6,000 of annual premium. But now what we're going to do is take $50,000 out of our policy, because remember we had over $66,000 at that time. We're now taking $50,000, buying this Tesla, and now we're going to make $976 monthly car payments back into the policy. So same thing, we're just buying a different car, running the $976 back in the policy, and let's see what happens. So this was our first 5 years, our $30,000 loan. Now the next car loan is $50,000. And again, you can kind of see the interest that goes down. We definitely have more interest than we did on the 30,000 car, but you can see how it drops significantly as well. We made payments of $11,712 every year, but in our last year, because our loan paid off, we only needed to put in $9,079, which now means we have $2,632 of overpayment that's now going into, as Sean King mentioned earlier, into paid up additions, which is the cash side of the policy, or it's just going to sit in our pocket for premiums for next year. And look at that. We have $112,852 in our policy. So sticking with that whole concept of what are our benefits at this point? Well, we have $112,852 of cash value. We have 2 cars sitting on our driveway that were paid for. That Toyota Camry was 30, the Tesla was 50. So that gives us a benefit of $80,000. Plus the total loan overpayments, about $4,000. Now, what did it cost us for this $197 of benefit? Well, we had $92,770 of premiums and dump in between month 1 and 120. Plus we made $93,000 of car payments. So isn't it true that we have out of pocket $186,000, but yet we have a benefit of $197? So now we have $1.05 of every dollar back on that car that we purchased. So the difference between these two is a little over $10,000. So one could look at it and say, I have made $10,000. You could look at, I've now got a benefit of $10,000 just buying cars this way. And we've got a death benefit of $302,000. Questions on this so far? And just kind of looking at some of the comments, and Andy, you're exactly right. We're not depreciating cars because what we're looking at is what was that initial benefit. We would have had to pay that anyway. So we're kind of keeping that initial benefit. The other thing that we're not really factoring in is, even if I went back to the first car, I could have sold the Camry, let's say for $15,000. Let's just say we cut it in half 5 years later. It holds its value better than that, I would imagine. But that's money that we could have used for the next car, which would, reduce our loan amount that we would potentially need.
And that's typically how most people would do it, Craig. We don't show it that way in the example because we want to just keep the cars parked in the driveway. But most people in real life, they would take that Camry and either sell it or trade it in on that Tesla, just because, most people, like, you're upgrading to another car. So, it really doesn't matter how you do it. But if you were to have traded it in, then obviously that's going to factor into the numbers, and you're going to be taking a lower amount of loan out, which is going to just change all the numbers. So it's easier just to kind of do it this way. But for your individual situation, folks, when we run your debt blaster or major purchase calculator, like when you start a policy, you're going to tell us, like, how do you want to do it? If you're buying cars, you say, okay, for the first car, I want to see it doing it this way, and then I want to see it with trading the car in, and I think I could trade it in for $15K. We can show how all that would work based on unique situations. But for today's teaching in the wealth webinar, all we're doing is just showing you're keeping every car in the driveway.
Yeah, and then TRM said, is the $93,660 the car repayment plus the insurance? No, so the $93,000 is going to be basically all of the payments that you've made from the first Camry all the way down to the end of the Tesla. So these are all the car repayments we've made, and that equates to $93,660. And then the premiums that we put into the policy are $92,000. So that's where you're getting the 186 is coming from the premiums plus the car payments.
Yeah, and the important thing, somebody said the death benefit goes down due to age. No, the death benefit goes down because of the way we designed the policy. So after the 7th year or the 10th year, depending on our design, Craig's going to show that in a second, we drop a term rider. So in order to do the policies and make them as efficient as possible, the name of the game is, well, number one, reduce the death benefit to the lowest amount, because that's where the cost of the policy is. And in reducing the death benefit, you reduce our compensation, our commission, because we get paid on death benefit, not on anything else. So the way we do that is we add a term rider, because, hey, Dave Ramsey, says it all the time, buy term, it's cheap. So we add a term rider, and that term rider was $594,000 of the 800 and some thousand death benefit that we did in the first car. So we drop that. We no longer need the term rider. So that's going to reduce the death benefit down. But that's another really good question.
Yeah. And so some people might be asking, well, why even put it in there? And it's going in there because of IRS rules that, not to get too technical, but the IRS has some guidelines on how much premium you can put in relation to the death benefit. And so if we were to put this $34,000 dump in and a $6,000 premium, and we didn't have this term rider on there, let's say the death benefit was $200,000, the IRS would say, okay, you can do that, but now we're going to make this taxable. And so we're designing these policies to put that term rider in there to adhere to that IRS guideline, and then you'll see at year 8. So basically year 7, we don't need that term rider anymore. That's why you're seeing death benefit go from $859 to $265, and then it continues to grow again. That's just because that piece of the puzzle got moved out. And as Chris mentioned, if you want that on for 10 years, 15 years, 20 years, we can keep it on longer. But when we do these designs, we're doing it with cash perspectives, and you might want that death benefit on longer. That's fine. We can do that. But good question. All right. So we're going to continue on, but before we move on, we're going to do a little trivia time. So what was the best selling vehicle in the US in 2024? So before you answer, let's say it could be a Ford F-150. It could be the Gremlin. It could be the Porsche or the Honda Accord. Now, I can't remember, someone said they had a Gremlin, but it's kind of odd that I threw that in there.
Craig, I'm going to go with the Gremlin.
You're going to go with the Gremlin? Okay, Chris is going with the
my money's on
Gremlin. Seen a lot of F-150s, Honda Accords. I mean, the Gremlin, I don't know. Those are pretty cool cars. All right. The Ford F-150 was the most popular vehicle in the United States in 2024. And matter of fact, it's been one of the top selling vehicles in the country for 47 years. My source on this is Google. This could be incorrect, but I just did a quick Google for fun. But isn't that cool that the Ford F-150 is one of the most popular vehicles out there?
Doesn't surprise me. The Millionaire Next Door, they talked about Ford F-150s, but there's another little hidden secret behind, well, I guess why Ford F-150s are so popular among millionaires and also business owners. And that goes into Peter's question, because Peter had asked, how to show us how to do this, but also get tax benefits from it. Well, I'm not a CPA, so I can't give tax advice, but Craig, just a simple question. I bet you know, do you think a Ford F-150 or a Ford F-150 Raptor weighs more than 6,000 pounds?
I think you have a point there.
It does. It is over 6,000 pounds. And according to that, that means that a Ford F-150, outside of all these other cars, would qualify as a car that could be used under the Section 179 deduction. So you could do a bonus deduction or bonus depreciation on this car. And depending on what year you did this, and I can't predict the future, but let's just say it goes back to 100%, you technically could get a write-off if this was used for business, solely for business. So you'd have to buy the vehicle using this system you just did, and the policy would have to be owned by either you or the business. So you'd buy the truck in the business name. And then you would basically do a 179 deduction, and you could write pretty much the whole truck off, or I can't remember where we're at now, 60%, I believe. You could get a 60% deduction on that vehicle. But out of all of those, that Ford F-150 is the only one I believe that qualifies. Maybe a Porsche Cayenne, but I don't think they tip the scales at 6,000 pounds.
Yeah, and that's a great point. So there you have it, some fun trivia. So far we covered some trivia about the best-selling vehicle. Chris, we talked about how people buy cars. So hopefully people are walking away with some great trivia as well. But let's buy a Ford Raptor truck. Here we go, 2025 Ford Raptor truck, $85,000. We are going to be making payments of $1,659. So remember, we're taking that $85,000. And I know we had a little bit of trivia in there, but I want to see what the number was. So we have about $112,000 of cash value in the policy when we buy this Ford Raptor truck. So the other thing too is, as we're doing this, I mean, we do have some money left over in that policy. That could be some of your emergency fund. It could be used for other things. It doesn't mean you only have to use this for vehicles. It could be a vacation fund, and then you recapture and pay that back as well. But regardless, we now have a Toyota Camry, we have a Tesla, and now we've got this Ford Raptor. And so if we look at the course of the 15 years where we bought the 3 cars, the Toyota, the Tesla, and the truck, you can see this is the column shows all the different loan payments, all of our different interest added up. And again, we start off, because we have a higher vehicle amount here, we have $3,710 of interest, and then it drops quickly. And on the 5th year, instead of paying the $19,908, we can only pay $15,000 towards that loan. So we now have $4,461 of overpayment. And what's cool is we now have $152,000 of cash value sitting in our policy by the time we've paid off that Ford Raptor truck. So let's take a look at it. And to others' points before, yes, we're not taking into consideration depreciation. We're just looking at the benefit that we had. We now have 3 paid for cars sitting in our driveway. Although they're not worth this, that's what they originally were worth. That's why we're adding it as a benefit. $30,000 Camry, $50,000 Tesla, and an $85,000 Ford Raptor truck. So our benefits now include the cash value of $152, plus all of these cars add up to $165,000. Plus, if you look at the overpayment of the Camry, the overpayment of the Tesla, and the overpayment of the Ford truck, we now have $8,632 that may have gone into a premium or our pocket. But we now have a benefit of $326,000. Our out of pocket includes the premiums of $102,000 plus the loan payments of $193,000. So we now have $295,000 is what this $326 cost us. So now we have $1.10 back of every dollar that we use to buy those vehicles. So where can I go and buy 3 cars, have them sitting in my driveway? Because maybe your teenage daughter has grown up and now she's driving your Tesla, and maybe driving your Camry, and you take your Tesla out every once in a while, and your Ford Raptor is your, just getting around town truck. But honestly, where can you go to buy 3 cars and get $1.10 back on every car you purchased and have $358,000 of death benefit?
I don't know anywhere. Anyone? And you know what I like about this, Craig, is we actually improved our car driving experience as we did this. In the other example we do in the 90-minute, we're just buying $25,000 cars, which isn't fun. Here we go from a Camry, nice car, but then we go to a Tesla, pretty sweet, and then we go to a Ford Raptor, an F-150, which gives us additional benefits if we wanted to take tax deductibility through our business and use the truck for business. Because, hey, listen, how many of you that own a business want to roll around in a Raptor? Like, sign me up. I love those trucks. And then it just wraps it all up and shows you the total benefit for using your own banking system versus everybody, anyone else's. And the one thing we don't do in this presentation, Craig, that I think would have been important to show is like how much money people, just the majority of the people, are just giving away buying cars. Like, we're making money buying cars without selling the cars. Everybody else is literally paying all that money. I mean, I think we did that in the beginning of how much the interest would be on each one. That money's gone from their family forever. Here, we didn't leak any money from our family. I know, yes, we paid interest to the insurance company, but the policy earned more in interest and dividends than what we paid the insurance company. So that's a wash. Matter of fact, we actually made money there. We made a spread just like a bank does. And then we got the cars, we got all the money back for the cars and the joy of driving them. I mean, it's that's what I mean when I said earlier, like if now when you've seen this thing and you've seen the math behind it, it's just hard to look at it and poke holes in it and say, this doesn't make sense. There is nothing about this that I think anyone could say doesn't make sense. It makes all the sense in the world. You just got to get over that first hump of saying, well, I don't want to buy that whole life policy, because that policy is one of the main reasons, well, I should say not the policy, but the uninterrupted compounding interest is one of the main reasons it works like this.
Yeah. And there's a couple comments I just want to address. So TRM is saying, but wouldn't it be a 2025 Camry, a 2030 Tesla? Absolutely. But what we're using is today's numbers. I don't know what this Ford Raptor is going to be in 2035, but what we're just kind of showing is if you purchase those types of cars over 3-year periods. So this could be, 10 years down the road, 15 years down the road.
But the other point there, Craig, is we had a lot more money in cash value than what we spent on the car. So even if it was that scenario, there was more, we had plenty of extra money. And I think that extra money would have been sufficient to pay more for the Tesla and more for the Raptor.
Yeah. And then one thing I just want to jump back to the policy design, because this is kind of an important thing to address is, could I have built a policy that was just extremely high cash value, would have made this look even better? And Chris and we talk about this kind of stuff. Like, we could do that. We could show a policy design that just squished out as much cash value as we possibly could, and it would make this example look even better. And we went with the 60/40, which is still a really good policy design. But if I made this even 80/20 or something like an 80%, most of our premium and money is going to the paid up additions, this example would have looked even better.
Well,
Right.
you did
So-
run that, but we decided not to show it because we wanted to show something more toned down. So
Yeah.
folks, we had another one that we almost presented, but we kind of made an executive decision to show the 60/40. We did one that was like, a really specially designed policy. They had a lot of cash value, and that one the numbers looked better than this. But again, we weren't trying to get you super wowed on the policy. We were trying to get you to understand the concept and the process of getting all the money back. So therefore, the cool part is could we make your policy better than this? Yeah, we actually have that example that we could show. And to Andy's point, he was saying, he thinks it'd be more realistic if we showed a depreciated valuation on the cars, which is tough because we really don't know what those cars would be worth. So we just did face value. But if we did kind of just hypothetically pick a value after 5 years, 10 years, and 15 years, then kind of showed that, you would basically then kind of, yes, you diminish it. It would be less flashy, but it would be less realistic because it's very unrealistic to assume that if somebody's doing this model, that every one of those cars would still be in the driveway. Very unrealistic. What those folks would have done is more than likely sold the car, the Camry, the Tesla, or the Raptor when they buy the next car, and they would have gotten a better price than kind of holding it and depreciating it the whole time. But again, Andy, it would be easy to show that, but if we were going to show it that way, we would show it with the really maxed out policy design, and it would still be a positive benefit. But it's a good point.
Chris, yeah, and one other thing I want to show is if you look at the way these premiums, you got 40 and then the 6 and the 6. The other thing we could have done to make this even better is you'll see right here we drop from 55.90 down to 19.20. That could be because that's all the policy could hold. This policy could hold more, but this would have looked even better if we would have continued putting in the 6,000, for the rest of these years. And the reason why is because it would add more cash value. So these numbers would just get better. So the thing I'm just trying to mention with this policy design is this is not some super duper, high performing policy. It's a really good policy, but it's not one of the best we could have done. And so we wanted to be kind of going into this with a moderate example just to show how the process would work, how this would flow. And at the end of the day, everybody's situation is going to be a little different. You may have to capitalize for the first couple of years to get the money you need to buy that car, and that's okay. But anyway, those are just some points I wanted to draw out on the policy design. Is all of these are going to be different based on your specific situation. Let's go down to the very, very end here. So this might be a first. I don't know if we've ever given homework, but Chris, I just felt like we needed to give our audience homework.
We did it one other time. Remember, we made people, go back and watch Earl Nightingale's The Strangest Secret in the World. So very similar to this.
Yeah. So everyone pay attention now because you have some homework, and it's really important homework. What I want you to do, and it needs to be done, step one needs to be done today. So go buy a BYOB hat. I need to put that in there. But also go buy this book. Okay. Get this book, and I want you to read pages 41 through 47. And why do I want you to read pages 41 through 47? It's because Nelson Nash goes through this exact, well, not exact, but the same process of how you can buy a car. And he goes through examples of using policies, capitalizing with CDs. But get the book, read the case study, and then Stephen, maybe Shauna, can you guys put the link in to book a call with a money mentor? After you've read the book and you've gone through this case study, book a call with one of our money mentors, because in that call, we can have a discussion about your specific situation. I see questions about how are premiums defined. Well, those premiums are going to be based on what your situation is and your savings, your cash flow, your age, your health. So all of those things can be determined on a strategy call with our money mentors. And once you do that and you get a plan, capitalize your bank and then go finance your own cars. Quit giving that money away to, the banks and the finance companies. So that's your homework. And we're going to be watching. So on next wealth webinar, we'll have to ask and see how many people did their homework. Oh, and don't forget to subscribe. Yeah, to Chris's BYOB Porsche. But that's all we have for you. Now we can just take some questions. If there's some specific questions, or do you want to jump into anything in more detail, we can do that.
I just got one other thing. I thought this was interesting. Last week, Shauna had asked the entire audience on Wealth Webinar to kind of talk about some of their milestones, since joining Wealth Webinar, from the first time. We had a bunch of first timers here. If some people could just voluntarily share their success stories of how IBC has changed their time. And some great ones came in. Anthony Henderson, I don't know if he's on here, but he shared that his wife's student loans are completely paid off. And it would have normally taken, and they weren't paid off because Biden paid them off, just setting the record straight. They would have taken 15 years to pay off the traditional way, making the normal payment they were making on the student loan. When they applied this strategy, what you just saw for cars, but just replaced the car with the student loan, they paid it off in 18 months. Now, here's a fun fact. Okay, Anthony is an engineer. If any of you are engineers or have worked with engineers, they basically they want everything to fit in a square box. They are very analytical and very money-centric and what would be the word, Craig? Just detail sensitive. So he's an engineer, so he knows how this stuff, has to work. And he's the one that used it to pay that off. But let me go into another one. I love this one. Shane's on here. So we got Shane Hollingsworth. He said, used earned returns to finance my Turo cars. I love this example. Completed one end, the end of last year and recaptured $385 a month and about to put a second car loan into my policy. So what he's doing is what you just saw, but then what he's doing is he's taking the cars and Turoing them for a portion of the time and then taking the revenue from the Turo and rolling it back in. So he's not even making any of the payments on the car. Somebody else is paying the payments on the cars back to his own bank. So not only is he getting all the money back, he's literally cheating the system. Well, not cheating the system, but he's using Turo and renting the cars to literally make those payments. And last one, Virginia Haskins said, we paid off a lot of debt and purchased a car through our IBC policy. I am charging 7% interest on the car loan to ourselves. We wouldn't have been able to do this without the infinite banking concept. Those are just a couple, and that was just from last week. So this year, what we're really doing is, just asking our audience to share their stories. Like, how has this helped you? How has this changed your life? And, when we ask the question, people give us answers and they tell us, hey, it's done this, it's done that. And that's what we love. It really kind of fills our bucket, if you will, fills our cup, because we love hearing those stories. And just the couple recaps on this in the final couple minutes, and I see some of the questions coming in, so we'll hit those. The infinite banking allows you to finance major purchases like cars while still growing wealth. Sean put these down. I thought this was a really good observation. So you're financing major purchases in your life, no different than you would with a bank, except for you're using your bank, but you're still building wealth while doing it. I mean, that's literally like a revolutionary thing. Like, it's almost impossible in most cases to buy major purchases, but yet build your wealth. Usually, like Craig showed with that one example, when you buy major purchases, you diminish your wealth. And then, yes, you build your wealth back up, then you buy another one, you diminish your wealth. And another key point, over 15 years, you can fund 3 vehicles while building substantial cash value. Again, if you were paying attention, the cash value was far superior to what we were actually paying for the cars. So we could have bought nicer cars, could have put some, black wheels on that Raptor, or put some of the V8 instead of the V6 in that thing. And then third, she said, this system puts you in control of your money, keeping your dollars working for you. There was nothing that Craig just showed that you weren't in control of. If for some reason you couldn't make the car payment 1 month, you're in control. Look at yourself in the mirror and say, hey, can I have a month break? Like, it's not like when you're using a traditional bank, they're in control. In this, when you're your own banker, you are in control. And it's not just a strategy, it's literally a mindset shift. I think that's the biggest thing that everyone on here has to overcome. It's not that the strategy doesn't work. We just showed you the math. Yes, we could, go back and forth and say, hey, we should depreciate the cars. No problem. We can do that. But at the end of the day, the math is still going to work out better than any other way you've ever looked at buying cars. So it isn't a fact that, or it isn't a matter of, does the strategy work? It's a matter of, are you willing to change your mindset around how you use money? That is the biggest hurdle we have. The biggest hurdle we have is not that we don't have plenty of people to talk to, that we don't have lots of great strategies and lots of great videos showing you how to do different things. The biggest problem we have is mindset. Like I mentioned, that one gentleman that I met with, I showed him how to solve major problems in his life. And not just his life. We were building a family banking system for him, not just solving his problem, but solving his daughter's problems. like paying all their debts off using this banking system. And it didn't take any money away from what he has. It was just repositioning existing assets. But at the end of the day, his mindset would not allow him to see what you just saw. And this happens all the time. And he went to his financial advisor, and his advisor, I don't even know what he said, but I'm sure he said, oh, that's stupid. Just keep investing your money in the stock market. You know, and I said to him, and he even commented, and I don't care if he's listening or not, because this is the fact. He even said, well, I know you said that the markets could go down, but I still think I'm gonna do better in the market. I know for a fact there's gonna come a day, and this year, maybe next year, that he's gonna think about that conversation I had with him when his balance in his investment account that his fancy-dancy, suited-up financial advisor told him he's gonna be able to do better in the market is half of its value. And he's going to remember that part where I said to him, this can guarantee your legacy, guarantee your money, and guarantee that your problem gets solved. Mark my words. When people take greed over guarantees, there's always going to be a point in time in the future where they say, I should have, I could have, I would have. Please don't let that be you. Can't help everybody. And I can't help everybody because I can't change your mindset. All you can do is that is solely on you. We can do the rest. Craig can run the numbers. Craig can run any scenario. We can show any situation, any problem being solved. But the problem we will never, ever solve for you is your mindset. So that's on you. That's your homework. Reading that section in that book, it's your mindset that we need to change. The math is the math. It doesn't lie. So with that being said, just imagine yourself driving the cars that you love, building wealth while doing it, and building a legacy for your family, all at the same time without working harder, longer, or taking on any additional risk. So with that being said, I'm going to put this final little call to action as we're a minute over here. If any of you are interested in changing your financial future for 2025, if you're willing and able to change your mindset around how money works and you want to see how this works, please book a call with us. I promise you on that call, the only thing the folks will do that you're talking to is try to solve your problem. The rest is easy. The mindset part, that's for you to work on. With that being said, folks, thank you all so much. I got one final thing. I'm going to turn it over to Stephen because we've got an awesome event coming up pretty quick, like in about a month's time. We're going to all be out in Utah at Sundance Resort for the very last Money Multiplier Experience event that we will ever do. So it is going to be a monumental one. Stephen, take it.
Yeah, I mean, I can't believe it's coming up so quickly, less than a month away. So kind of last call for this, get your travel plans in place, flying to Salt Lake City, or if you're local, you can drive right out to Sundance, but an absolute beautiful spot. I actually just have my snowboard over here. I got out and dusting off all the dust off it, and like it's used not too often down here in South Florida, but getting ready for it. So looking forward to a fun trip out in Sundance. But basically, a few years ago, we were discussing as a team, doing live events, and we do several different types of events. We do our virtual events. We do Money Tank with PMC. We do a lot of live in person. We attend a lot of masterminds. And so we said, how do we want to do ours a little bit differently? Where it's not just kind of the same thing where you go in and, go into a ballroom and watch speakers at the front of the stage. And it's all great. Those are very important as well. But we just wanted to do things a little bit differently. I mean, Chris, your background as a professional snowboarder and athlete, and I know myself, I've been very athletic and skied and snowboard my entire life, and our whole team is very into that kind of thing. And so we said, what if we kind of mixed adventure and business into one event? And then we started just talking about, family and, life and things like that. And at the end of the day, what's all this money for? Like, why do we all work so hard? And it's for each other. It's for our families, for our friends, and it's for the experience of living life. And so we said, that's it. Let's call this event that we're going to put on a couple times a year. Let's call it the experience. And so that's what we designed and created. So over the last few years, a couple times a year, we've been traveling around to different parts of the country. We've been down in Mexico. And what we do is we just spend a few days together. We limit it to 25 people. We bring in our team. We bring in some experts, some very successful business owners, and 25 students and clients. And we get together and we spend a few days together just living life, experiencing life, and doing different things. So this one's in Sundance, Utah, obviously next month in February. So it's going to be February 6th, 7th, 8th, and 9th. And each day you're going to have a different activity you can pick to do. So if you're somebody that wants to get out there on the mountain and do some skiing or snowboarding, great. We'll get you the lift ticket and the rentals, or you can bring your own equipment and we'll go cruising down the backside of the mountain. And Sundance is a really beautiful place. If you'd rather, be a little active, but maybe you're not into the downhill stuff, they have cross-country skiing, I believe, or they have what do they call where you put those big things on and walk in the snow? Snowshoes?
Snowshoe.
They have sand shoes down here, but snowshoes. Yeah, so you could go snowshoeing. They have a beautiful spa. They have the hot springs. They have different like artsy activities you can do. So each day you're just going to pick, what do you want to do? And we'll go in little groups and we'll do it together. But we're going to wake up in the morning, have breakfast together, get together for lunch. We have dinner together. We all meet at one of the coolest bars in the country I've ever been to, the Owl at Sundance Resort. And if you've never been to Sundance, it's a resort that Robert Redford designed this place many years ago, and that's where the Sundance Film Festival originally, was. And actually, one of the ones we did a couple of years ago was really cool. We watched, what's that movie, Notre Dame movie?
Yeah.
Rudy. And we actually so we watched Rudy in the theater where the original Sundance Festival was held, and actually had Rudy come and hang out with us for the movie and did a little intro. So we always do fun little things like that, helicopter rides. I don't think we can do helicopters in the wintertime this time, but anyways, it's just an awesome event. And it's, over the years, what I've learned is the clients that come to that, I watch what it does for them, the relationships, the confidence. It shows people like, hey, I can get out there and hang with people like Chris Naugle. I can share and I can provide value to other people that are there. And I've just seen so many people's, not only businesses and financial lives accelerate from attending the experience, but almost more importantly, their personal lives and what that's done for them. So just an incredible event. And just because of everything going on this year with Private Money Club, with BYOB, with Money Multiplier, we're only able to schedule one experience this year. So unlike in the past where you could kind of choose a winter one or a summer one, we're only doing this one coming up in 3 weeks. So if that sounds good to you, we'd love to invite you. We have a few spots left, a few tickets. We can get you in. So just reach out to us. I'll put the website on there, but if you have any questions, just reach out directly to Shauna and she can kind of walk you through it and make sure that it works out for you, the travel and everything like that. But for those of you that are attending, I'm really looking forward to seeing you guys. We're going to have a great time. So hopefully that was all right, Chris.
That was great. Sorry, I'm just responding here on a couple things. Great questions coming in. So folks, I really appreciate the questions and all the Q&As and chats you put in. They're just great. And you know what? We can teach till we're blue in the face, but really the most important thing is when we're teaching that you're asking questions so that we're making sure we cover all the bases. Sometimes we go over things because they're just like elementary to us because we do this every single day. There's not a single person on our team that isn't applying everything you just saw today in their own lives for cars, debts, buying and investing in real estate and lending on real estate. Like we do this every day. So sometimes we kind of run over the simple little things, the little nuancy questions that are so vital. So I appreciate each of you asking those questions. And also I really appreciate you all staying. I know we're 10 minutes over here. So appreciate your time. And thanks for joining us for this. We'll see a bunch of you this afternoon, if and only if you are subscribed to my YouTube channel, which is at the Chris Naugle. So now I just asked you to subscribe to 2 YouTube channels, not just BYO Porsche, but also at the Chris Naugle. And make sure you click the bell, and that'll notify you when we go live this afternoon at 4:30 p.m. Eastern for Ask Me Anything Happy Hour. It's kind of just this cool little show where the entire team just answers all your questions. So come on, ask questions, and let's have a bunch of good times. Thanks for joining us today. We'll see you on the next. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.